We'll wait another minute and then we'll get started. All right, well, let's get started. Good afternoon, everyone. We hope you are healthy and well. I'm Andy Byron, a senior advisor and certified financial planner at HC Financial Advisors. We welcome you to the 2021 Economic Outlook webinar presented by our Chief Investment Officer and CFA, Steve Biggs. 2020 was a very interesting year, to say the least. From an S&P 500 market low of minus 34% on March 23rd to an end of the year return of plus 18.4%, the markets were certainly filled with much uncertainty and volatility. We're thankful we're now in 2021, that more vaccines are being manufactured and that the vaccination distribution is underway. And we look forward to the day we can return to our Lafayette office and meet with all of you in person. I know Steve's presentation and outlook for this year will be interesting, comprehensive, and thought-provoking. There will also be time for Q&A after his remarks. In the Q&A section on the bottom of your screen, there's a place to enter any questions you have. Please use this section as Jane Lang, one of our advisors, will be gathering the questions and providing them to Steve for his comments after his presentation. Thank you again for attending this webinar. And now I'll turn the meeting over to Steve Biggs.
Thank you, Andy. And as Andy mentioned, it was quite an eventful year last year for 2020. And there's a lot to cover. So we're going to go through some of this probably fairly quickly and collect all the questions for the end. But today, what we want to look at is kind of a review of the economy, how things went in last year, and how does the recovery look going forward. Review of markets of 2020, where that leaves valuations headed into 2021. What's happening with the federal debt and the dollar. Go back through the election and how that affects policy expectations going forward. And then our outlook on markets for 2021. And as mentioned, please type any questions throughout the course of the presentation. We'll try and keep plenty of room for questions at the end. So starting with the economy, this is gross domestic product. So, no surprise here is that dotted blue line is kind of the trend growth rate's been right around 2.5% on an annualized rate for a number of years now. Then we got into 2020, as we shut things down about mid-March, that was enough to hurt hurt growth, actually produce a decline in the first quarter with a steep drop in the second quarter as most of the economy was closed down through at least April and May in many parts of the country. As things opened up, we got a sharp bounce in the third quarter of about 33%, and then continued sustained growth, at least a little bit in the fourth quarter. However, just not enough to get back to where the economy was before this all happened, and still well below trend growth rates. So still have some catching up to do as far as the economy goes. And then as we expect, a typical recession, this showed through into the jobs number. So we had just a huge spike in unemployment initially as many businesses closed, and that really that rebounded pretty quickly as things reopened back up. So all the way to 15%, much higher levels than the previous recession. But things have kind of leveled off at a fairly elevated rate, close to 7%. And further gains are probably going to be much slower. We saw unemployment claims start to tick back up in December as more things were closed down as we fought another virus surge later in the year. And this is kind of the real-time economic data, or what we call high frequency economic data. And again, just shows that the hardest hit sectors of the economy right now are those frontline sectors. So people through TSA checkpoints or traveling on airplanes, still very low. A little bit of a bounce for the holidays over Thanksgiving, Christmas. Restaurants have recovered in the summer and the fall, and then well back down as more have closed down. Hotels are still down, although spending has stayed pretty steady. That light blue per line, I guess it's off a little bit, but that has held up pretty well. And of course, home activity has kind of gone crazy with low interest rates and people buying homes. So that's one part of the economy that is still fairly healthy. And that's what we're seeing in the jobs. That chart on the left shows job creation by industry. And while the overall economy has shed a number of jobs, many of these industries have held steady and pretty flat on the year, where all those job losses are coming from service providing jobs or leisure and hospitality, those kind of areas. And on the right just shows the more recent 1 month change. We're actually growing the economy, growing jobs in other industries, but still those frontline positions have been still hit pretty hard. It's still shedding jobs, and probably reaccelerated again towards the end of the year. So for most people, the economy is pretty good. It's that 15 to 20% that are exposed to the real pressure from the virus shutdowns. So the good news is, as we mentioned, there's vaccines on the way. Vaccines are here, and people are already getting vaccinated. So that is really what we need to have a sustained economic recovery, which we would expect later in the year. So the Pfizer with BioNTech and Moderna, both on the market here and approved for use in the U.S. I think 8 or 9% of the population have received at least one shot. So obviously it's going to be a fairly slow and tough rollout. The good news is, Pfizer is actually ahead of schedule, ahead of production. They just announced they think they'll produce 20% more than initially expected. They've signed licensing agreements. Could get them up to 2 billion doses worldwide this year. So as those roll out, that will certainly help. We've got a couple more in the pipeline here. So Novavax announced their trial results last week. That was very good, around 90% efficacy. So that will probably get approval here soon. J&J was probably a little less exciting to most. It's 60% efficacy, but probably still a good chance of approval because there are some uses for it. They had no cases of severe disease that required hospitalization. It's very easy to make. They can make 1 billion doses in a year, and it does not require the cold storage. So for some areas that could be a benefit, and that could be something we see down the road, helping maybe developing countries, places that don't have access to some of that cold chain distribution that we do in the United States or developed markets. And then, there's also questions about other variants of the virus. They've been pretty effective against the UK variant and less effective against the South African one. But again, they still do some strong efficacy. And by comparison, the flu vaccine is only 50 to 60% effective, and millions of people still get it. So should provide some relief. And this is just an analyst estimate for when we get that herd immunity, or enough people are immune to the disease that it just doesn't spread, even if it shows back up. So you don't need 100% people vaccinated. You just need enough that there's not enough potential carriers walking around. So this is kind of the estimate. Really the orange in there are people that have already had it. So it appears to be fairly good immunity from having it, and blue is is vaccinations. So CDC estimates about 85 million Americans have had COVID as of January 15th. Obviously, that will continue to tick up as we go through this. Looking at about 50 million or about 100 million people by late spring. That's just kind of the calculations of what they're expected on vaccine availability. And then there's a group called Good Judgment, which has a super forecasting site. It's basically a consensus of experts. They're saying a 96% probability of 100 million people vaccinated by about May. So that's kind of consistent with this projection. Obviously, there's some risk to this. One would be, any major hiccups in manufacturing. The other would be, mutations in the virus, which we have seen some. Fortunately, there's still some efficacy on the viruses we have, or the vaccines we have to help combat that. And there's also work being made on boosters or changes in the vaccinations, which don't require the same effort that the initial vaccination did. So the research effort is shorter. That can be put together in a couple months. So what happened to stocks last year? It's a pretty wild ride, as we mentioned. So for the full year, the S&P 500 or U.S. large cap stocks was up about 18%. Certainly, unexpected given the economy. But that really, there's a big separation. So Russell 1000 growth is, the growth stocks. So companies that tend to be fairly expensive, but have higher growth rates. That was up 38.5%, and value stocks actually pretty flat on the year, up only around 2.8%. So, at the time we gave this last update, that growth index, was up. So this was in July. Growth stocks were up, but the value part of the market was down. So it was really kind of driven by those big five stocks that we talked about, Amazon, Google, Facebook, Microsoft. They kind of really drove the S&P 500 to positive returns, where we pull those out, the market would have been down. So this is a little bit of a healthier sign that value came back in the fourth quarter, and that was the leader. It shows a broadening out of the market, and not just this leadership by a handful of names that continue to get flows into them. What really helped this value rotation in the fourth quarter, the third quarter is pretty flat, but the fourth quarter we had two things. One was the election, and one was the other was vaccine news. So we got the vaccine news that both Pfizer and Moderna released their results at about 95% efficacy. That was well above what expectations were for a vaccine going into this. I think anywhere from 50 to 70% would have been what people were looking for. So it kind of showed that there is going to be at some point an end to this, and the economy will recover. So those value tends to be more cyclical names. So those are the ones that will benefit the most from a recovering economy, and that's where investors went. As far as the election goes, again, that's the expectation for further stimulus to help support the economy and support markets. And then it's also expectations for longer term infrastructure, which is also stimulative to the economy, would help those kind of more cyclical value stocks. So between the two of those, that help drive value stocks, and help take the rest of the market catch up with some of the growth names. But the other unusual thing that happened last year is there's kind of a saying that where you hear in the news that Wall Street's not the real economy, that stocks don't follow what's really happening to Main Street. It's not really true. Historically, there's a high correlation between stock returns and the returns and how the economy is doing. So when the GDP growth, is showing typically running around, between 0.6, 0.7, 0.8, of correlation is explained by how the economy is growing. One exception, early 90s, you had a pretty good economy, but the Fed kept raising interest rates pretty aggressively. That put some pressure on stocks. So they had some negative volatility there, and that dropped the correlation. But here you actually go from a very high rate of correlation to negative. So as the economy was sinking, you had stocks going up, which is very unusual. I haven't really seen that before. That correlation was broken. So, that just speaks to how unusual the year was. And so if stocks are going up while the economy is shrinking and earnings are declining, that means that valuations are rising because you've got less of a business and a higher stock price. So if we look at forward price earnings ratios, it's kind of a good thumbnail. Look at a profitable company and how much it's worth. At the end of the year, that number was about 22 times forward 12-month earnings, which, as you can see on this chart, goes back to 1995. Shows that that's about as high as the price earnings ratio has been since that period in the late 90s, early 2000s. There's dot-com bubble, the tech bubble, whatever you want to call it, which was another period where valuations were very high. And then they came down, and that lower one is what you see in the last recession, great global financial crisis, great Recession. So here we're back at high levels. So, is that alarming? You can look at it different ways. Realistically, the stock should be a discounting mechanism. So they are expected to price in what is happening in the future, not what is currently happening. So currently happening is the economy is under pressure from a global pandemic. So markets are clearly pricing in, looking past that and pricing in normalized earnings. So the investors clearly see this as a temporary setback to earnings, not a permanent situation. And that, stocks, companies, the market is a group of individual companies, and those individual companies, we want to value them on what we think is going to happen over the next couple of years, regardless of whether they have a one-time hit to earnings. So that would be the case for why valuations are higher. That doesn't always happen. Obviously, you can see why in 99, you're at the peak of a cycle and people are still paying high valuations. It should actually be the opposite, where the last recession, earning valuations were very low on depressed earnings, which you would think they should actually be higher. But I think in those situations, they were viewed as more permanent than what we're at now, where it's just a 12 to 24 month impairment of earnings and results. So that's part of it. That thing on the top there, that table shows other valuations. I would say they all look high historically. The one exception is when you compare it to bond yield. So bonds have gotten very expensive as well, and you're not getting much interest, much yield on bonds. So that makes stocks look more attractive. And this shows the earnings numbers. So you can see, in past, when we've had earnings drop, 08, 09, that stocks dropped. 2015 was a bad year. Those blue bars are estimates. So the low one is 2020. You're expected to have a pretty good amount of recovery in 21. Now those are estimates. Some of them could change. Sometimes they come down, sometimes they go up, but roughly around there, with 22 being the full year. So the full year of recovery. So the first half of this year is likely to be pressured again, because we're still in the midst of the virus here, and we've had almost we're actually kind of the worst of it. So the next quarter or two are likely to be depressed. But when we looked at 2022, those are kind of the numbers that should be more normalized. And as far as a price earnings ratio, they're trading at 19 times earnings, which is still elevated, but it's much closer to the long-term average of around 17 or 16.6 times earnings. So do they look at the stocks look a little bit expensive? They do, based on that rationale. But we have to take into account low interest rates, which makes stocks look more attractive for a number of reasons. And why do we have low interest rates? It's the Fed is really driving liquidity here. So, prior to the 2008 financial crisis, really all they did as far as liquidity is buy, overnight repurchase agreements, for fairly limited. They then, to help keep longer rates down, started buying treasury bonds and mortgages. So those kept longer rates down, and quantitative easing at the time, that has really been ramped up under the current situation. So it's kind of lessons learned in 2008. So in addition to bonds, treasuries, and mortgages, they've also started buying corporate debt. They've also, including junk debt, they've said they would support stocks by buying corporate equities. I know word that they've actually started doing that now, but we do know they're the second largest holder of bond ETFs, this particular bond ETF that iShares has. So that's certainly made a big difference in the market. What it does is keeps interest rates low because it keeps demand for these bonds high. They're essentially buying all the treasuries that the government's issuing, so that keeps rates low, and it just introduces a lot of cash into the system that then goes into riskier assets, such as things like stocks. So that is certainly a big support to the market, and a big supporter to valuations right now. Obviously, at some point they could stop this, but it doesn't seem on the near-term agenda at any rate. So, so as far as valuations go, obviously, there are some concerns. This is what were you thinking? That's Scott McNealy is quoted as saying that. It was a couple of years after the dot-com bubble in the tech bubble, and he was referring to his own stock, Sun Microsystems, and asking why people would pay more than 10 times earnings for a stock. Unfortunately, he said this a couple of years after the dot-com bubble popped and not during it. But the idea is, and it makes some sense, that 10 times sales is if you're a stockholder, you have to get 100% of sales over the next 10 years to recoup that money. So it seems like a very high valuation, and that is a concern. So if we look at stocks trading at that level, over 10 times sales in the S&P 500, and the S&P 500 is fairly established companies. It's not like a small cap company trading at 10 times sales because you think they're going to grow very quickly. It is starting to get up there. So, there could be some froth in the market. We hit almost 40 stocks had that valuation back in 2000, and it's held around 10, and now we're getting close up to about 30. So some reason to look out for some stocks. And as far as what we have that's out there trading at sales, that kind of level, Microsoft at 10.9, that seems really expensive, but they have a 35% operating margin. So if you actually look at the earnings per share, if you value it on earnings, it actually looks much more reasonable, which is kind of unusual. And then these others, obviously Tesla is in the press a lot, NVIDIA, PayPal, Adobe. I don't know if they are ever going to get at that size, ever going to grow into those valuations. But I would say they are all quality companies. So if you're going to pay up for a company, I guess the quality makes some sense, where I think that's the difference between now and what we saw back then is the lower quality companies are not trading at these valuations. And you had money spill over from high quality to low quality companies back then, just to try and catch the market. So that you haven't really seen. Other kind of areas of froth we've seen, GameStop up 14 100%. That this is not still correct. This was a few days ago, so it's come back down. So I think in 2000 we had day traders. This doesn't seem like it's that big of a trend. I think this is, maybe when people go back to work, this kind of stuff ends. Maybe it's a function of locking people inside and sending them checks for $1,200 each. Everyone goes out and plays on Robinhood, but it's not to the level that it was back then. So I don't see it as a trend like day trading was. And IPOs have looked. IPO market has really took off the second half of 2020 and probably got a little overheated. This is DoorDash, which I don't know if that's the best example of an overheated IPO. Probably a little bit expensive. Obviously growth may experience a bit of a headwind as we come out of the pandemic, but there are a number, especially through these special purpose acquisition companies or SPACs have been in the news lately. That's kind of, I think, overheated the IPO market a little bit. And this is the value of the NASDAQ 100 relative to the S&P 500. I don't want to take too much time on this, but basically showing that there is a lot of flow into names like Amazon, Apple, Tesla, Facebook, NVIDIA, Google. Those are the big names in the NASDAQ 100. It does make sense that the new economy has taken over and is better part of growth. It peaked in 2000, and then it's kind of been a slow climb up. It's probably accelerated just a little too much. I do think there's probably a little too much focus on these companies. There could be some froth there, but it's not necessarily as much as people think. And then there's certainly parts of the market that have not done well at all. I mean, so if we're saying, what do we think of stocks? I mean, there's certainly parts that could do much better as we recover. So, online retail and technology obviously are the strongest ones at up 69%, up 44%. However, banks were down last year. Healthcare was pretty flat. Utilities were flat. There's a lot of parts of the market that still look really attractive, and whose outlook has improved over the last year, but not necessarily reflected in the stock prices. So it's kind of hard to look at the market as an overall whole. And what we're trying to say here is that there's certainly value still there in other parts of the market. And another part of the market, not in the U.S. that looks attractive is non-U.S. companies. This is an area where you go on the left there. That gray line is what the S&P 500 has done, and the purple is the all world index ex-US stocks. And you see that's trading much closer to its historical average on valuation, valuation wise. And we still should get an uptick, pretty solid growth over the next couple of years as the world recovers. So seems to be a lot more growth opportunity there. And then on that right shows the US market compared to non-US. So, how many times that's divided into US stock prices. It seems to have reached a peak. That trend may be reversing, but it's certainly still well above where we think it should be. And then, in addition to valuations, you could get a benefit from a weaker dollar because the US is running huge fiscal deficits and trade deficits, which generally would lead you to believe that the value of the currency would decline. So we'll expect to see, the outlook for the dollar is probably fairly weak relative to other developed market currencies. So getting into the federal debt and the dollar, we've run a huge amount of debt to trying to fight this crisis, which is a good thing. It's more important to try and get out of the crisis we're in than protect for worry about too much about the future. So, they have done a good job at protecting the economy and limiting long-term damage, but there's coming a massive amount of federal debt. So this is the 2021 forecast. expected to run close to $2 trillion in debt. I think that's probably going to end up being higher. There's probably more stimulus being talked about, which is kind of amazing considering total spending is 5 trillion. So over a third of spending is debt financed. And that's really adding a big burden to the debt. It does, it adds to the economy because the government's putting much more into the economy than they're taking out through taxes. So it is stimulative, and that's good. But this is something that's going to be with us for a while going forward. And if we look, how debt levels are maintained, this breaks out government, household, and corporations, excluding banks. So households are in really good shape. They're that light blue line. Debt's come down significantly since the financial crisis. It's estimated that about 70% of households have put their stimulus checks into either savings or paid down debt. So that helps. Corporations are okay. I mean, they were a little bit high and it's ticked up, but that's due to low rates, not financial distress. A lot of companies taking advantage of below 2% interest rates on corporate debt to redo their capital structure, retire some equity, or buy back some stocks, and lean a little more to the debt side. So the government that's really gotten up there, generally consensus is that 100% of, if you're over 100% GDP, that's going to be a headwind to growth going forward. So that's the concern. We're certainly over 100%, and that could hurt GDP growth going forward. So there has been some concern about the dollar, and this is when you see money flow into other things like gold is there on the right. Fear of all this liquidity being put into the market. By not only the Federal Reserve essentially printing money, as people are worried about inflation, and then in the government spending deficits. So gold has been a historical store of value, obviously. So that has come off a little bit since the peak panic, but it's still had a good year. And then people put money more into cryptocurrencies, so that was probably more of a speculative bubble earlier. Now it seems to actually be a place that people are looking to store money outside of the US dollar and other currencies as well. I mean, we're not alone in having a massive deficit. So cryptocurrencies may at some point take over some of this. I think at this point it's still, I don't know that we've seen the one that does it. It's some, people like about them, decentralized ledgers. So not really controlled by a central bank. The problem is that makes them not scalable. It's hard to manage all this. The tracking the ledger is too complicated, and there's some security risks. You could get hacked. But at some point they may work through this, and the other, I've seen major issues. No one's controlling the supply, so they tend to be extremely volatile and not really representative of something like a currency. So we had an election. Democrats took over, obviously, all three branches. It wasn't quite the blue wave that we had thought about at the time, but so the Democrats controlled presidency. 50-50 in the Senate. So with the Vice President Harris, we get the tiebreaker there, and the majority in the House has narrowed to 11 seats. So really, things need to be pretty bipartisan to get any major legislation through. So we don't see the risk of any. The market doesn't like big surprises. We don't see the risk of a huge unexpected policy change as that likely. The number one priority for everyone is going to be fiscal stimulus over the short term, and the number two priority seems to be infrastructure, which is more kind of a longer term stimulus. So that's where they're going to focus probably for this year. We don't see tax being brought up until 22, most likely. Also depends on how much support, bipartisan support, they get for the first two. If they can get 60 votes for stimulus and 60 votes in the Senate for infrastructure as well, they won't need to use reconciliation, which means they could use it for something else and only need to pass tax legislation by 51 votes, not the 60. So that could accelerate it, but really it seems to be something that is down the road, because of course tax increases are the opposite of stimulus. They are a drag on the economy. So I think the focus is really for 21 going to be trying to recover from the recession we're in. Most likely taxes that are affected are probably corporate taxes. They went from 35 to 21. Most people thought 28 was a pretty good number. So I think it's likely they take them back to 28, and then that top tax bracket for high income earners is probably something else we'll see go up. If you look at these are vote records from the 2020 Senate. It's very moderate, because really you're only as liberal as the 50th most liberal senator, which in this case is Joe Manchin of West Virginia, pretty much right on the center there. It doesn't really matter how liberal Elizabeth Warren or how conservative Ted Cruz are. That's where policy is decided. And you've got several senators in traditionally very red states, Joe Manchin and Kelly in Arizona, that are up for re-election in a couple of years. So we don't see any huge disruptive legislation coming through, but hopefully a little more kind of central and bipartisan legislation. So, we've talked about inflation a little bit, and it has remained low. 2008, with the Fed buying bonds, and everyone was waiting for inflation to start, and everyone was just bracing for runaway inflation, and it stayed extremely low, 2% range. So that's it's kind of hard. People aren't really, it's kind of, people are still wondering when it's going to happen. We'll probably see a short one-time pop in the summer, or whenever, enough people are vaccinated that everything opens up, because you're going to have a lot of demand all of a sudden, and probably still diminished capacity in a lot of these kind of hospitality and entertainment industries. So you'll see a short-term pop, but that's not really long-term inflation. And long-term inflation is probably the biggest risk to some of these stocks we've been talking about, the big growth names. So a company like Tesla, you're buying that. You're not buying that because what they're doing now, they're basically breaking even if it weren't for carbon credits. So you're buying Tesla because you think they're going to make a lot of money 10, 20 years out. Inflation devalues that. So inflation traditionally has been the enemy of growth stocks. So that would be a risk to some of the higher those higher valuation names. So this is historical inflation, still very low. And the one thing that could grow longer term inflation is that I see on the horizon is change in how the deficit is distributed. So a couple of years ago, some of you may have heard, we started hearing this term modern monetary theory, or MMT. And the theory is that you can run the deficits as high as possible until you see an increase in inflation, and we haven't seen it. So in 2019, we got to $1 trillion in deficit, which was pretty extraordinary, given that we are 10 years into an economic expansion. Typically that's when you'd expect to be running surpluses and paying down the federal debt. That's that through history, that's what's happened. So we could say that we've run $1 trillion deficit and no inflation. But I think I've shown this chart before. It matters how that deficit is constructed. So this chart shows that on the right there, the top 10% of earners spend 64% of their income, which means they save 36% of it. The bottom 90% is 99% of that income gets spent. They don't have the luxury of saving as much. So if you're running a deficit by cutting income taxes on the top, lowering the top income tax bracket and cutting corporate taxes, that generally helps the 10%. So that money goes to, they're already spending as much as they want to spend. They don't need to buy anything more. So that money generally goes into savings or, more likely stocks, maybe some bonds. So it drives the asset prices up. If you decide to raise those taxes back up to where they were before and take that money and spend it on infrastructure. So we're not saying that the current makeup of the government is going to reduce deficits below what they were before, but at least redistribute it to say it's the same. If you're going to take that money and then spend it on infrastructure, you're probably giving higher paying jobs to some of these people that are on the lower end of the earning spectrum, and putting more money into the economy. So, that group is spending any extra money they get. So that would go into goods and services and actually drive the economy. You would get stronger economic growth, but with that would likely come inflation too. So that, because of the policy, government policy, we could see inflation where we hadn't seen it before. And just showed there's ways to invest for inflation or uninflationary environments. So we'd be a little more cautious on big growth stocks. We see things like infrastructure, raw materials, those do well during inflationary environments. Real estate, real assets tend to do well. So there are ways to invest with inflation, and some inflation stocks actually tend to do pretty well too. I think it would be more on the cyclical part of the market than the growth part of the market. So how does that look going forward? We've got, with earnings being pulled in, some of those returns being pulled in, if we were typically coming out of recession, stocks would be at low prices, and we expect a rapid recovery in the next couple of years. That's probably already been, we've already gotten that, we've already got that recovery we would expect through 2021. So that probably limits our outlook for the next longer term outlook, at least going about 10 years out. So this is a Goldman Sachs estimate, and probably pretty well reflects what most people are thinking, that if, historically the average annual return on the S&P 500 is right around 10%. So if in this case, we'll take that down a little bit to about 6% expected return. But it's still the better asset class to be in, because bonds are returning so low. 10% on a 10-year treasury bond, you can get to 1.5, maybe a little bit more on a corporate bond if you take some credit risk. So even at the lower return outlook at 6%, that's still a 90% probability that they outperform bonds and 87% probability that outperforms inflation. And the probability of negative performance over a 10-year period is still very low. They say 8%, but there's very few 10-year periods where stocks have been negative returns. So we don't see that changing. Bonds, on the other hand, I need to be a little more careful there. It would be easy to say stocks are expensive, so let's move a little bit into bonds. But in this case, the blue line here is the yield on bonds. So average is a 10-year treasury. So on average, over the last 60 years, almost 6% right now, 0.93. But inflation, if you take inflation out, which is right now 1.65, that gets you to a negative yield of 0.7%. So essentially you are losing purchasing power by holding a bond for any period of time. And this is with extremely low inflation numbers there, which we do expect to come up, whether they go above that 2 to 3% level that they've been stuck at the last 12 years. We don't know that for sure, but it's certainly likely that they increase over that 1.65%. That was very low. There are other places to find income, both yield and returns outside of fixed income. And, that might be what we need to do. Even stocks are yielding more than most bonds, although you might get a little bit of volatility. But some of these real assets, things like real estate investment trust REITs are much higher. Some of the credit areas like high yield have gotten very expensive, a little unattractive, but there is kind of private debt. So direct lending, there's private equity, things like that can generate some income for people with income needs, much more so than bonds. So the outlook for 2021 is, we think the economy should continue to recover from low levels, with the stronger growth really happening in the second half. The first half, especially the first quarter, is still going to be challenged. Although there's some parallels to 2000, there's many differences. So more cyclical and non-US names still look relatively pretty attractive, versus some of the bigger growth names that have carried us the last few years. And so it's really unlikely for stocks to decline as the economy recovers. You've rarely seen an economic recovery in a down market in stocks. The biggest risk we feel to valuations in stocks is inflation. So that's probably that. We think that's the biggest risk overall. I think stocks are unlikely to go down because of the economy, because we don't expect the economy to contract, and unlikely to go down because of valuations. Valuations rarely drive stocks. I think the biggest risk to stocks going forward are inflation. But if interest rates and inflation stay in check for 2021, which I do expect them to this year, I don't see that being a factor. I think the Fed is certainly committed to keeping rates low for 2021. We do expect at least moderate returns in stocks, maybe the mid single digit range versus what we saw in the last year. But I don't see outside of a big shock to the system or a big inflationary spike. I don't see much chance of a down market. So at least in stocks, and bonds are another concern. If we see rising interest rates, rates don't need to rise too much for bond prices to fall, because of rates are so low, and the duration of bonds has increased because more and more people are issuing bonds. So that is a bit of a risk, but overall, that's our outlook for 2021, and we'll see if we have any questions.
Yeah, we have a couple questions, Steve. So one of the questions is, there's much concern about inflation returning with a vengeance. And you said, inflation was the biggest risk to some of the big growth stocks, but could you comment on what this means to individual investors like our clients?
Well, I think individual investors and anyone I think you just need to be aware of how you're invested, and maybe the growth leaders over the past couple of years are not the best opportunity going forward in 2021. I think the cyclical recovery kind of takes hold, and some of those value stocks will do better. And if we are in a prolonged inflation environment, there's still plenty of opportunity in stocks. I think we just need to look a little bit, expand our horizons from what we've seen over the past couple of years, and where we're just seeing the big growth lead. So and I think valuations are high, but there's opportunities out there that we haven't really. Banks would be a big beneficiary of higher inflation and higher interest rates.
You mentioned that you don't think this GameStop situation will have long-term impact when people go back to work, and that we've had sort of waves of day trading in the past. Can you talk about this phenomenon in terms of what kinds of impacts it could have on policy or regulations?
Yeah, I think regulators are looking in to see what happens. I mean, the story is being painted as a group of, whatever you call Wall Street bets on Reddit, board users rising up against Wall Street and trying to take out some hedge funds. I think there's something deeper there. I think there's probably some instigators that made a lot of money, and there's probably a lot of people that jumped on the forum and lost a lot of money. So I think that regulators would be looking at that. I think regulators have been looking also at what happened with Robinhood, which was the trading platform that a lot of these people were using, simply just ran out of capital. It doesn't look like there was something more sinister than that as far as trying to block the buy orders. And then the other thing is, the 130% short interest in a stock is almost, it seems like you should only be able to trade each share short once. I think that is, almost kind of what we saw in the subprime mortgages. Like, we didn't realize how much leverage was on top of each subprime mortgage being issued. It wasn't just the one mortgage; it's the 10 times leverage that people had invested in. So, maybe trying to limit the short interest to the actual float of the company would be a good one.
Is it a coincidence that the NASDAQ and the Dow met around 1999 and again today? Is there a reason for concern?
Yeah, I think that was one of the parallels we could draw between 99 and today. But if you notice, that chart was a much more gradual step up than it was back then. So I think part of it's just, these companies are, the new economy is kind of taking over for the old economy. So e-commerce, mobile or Apple with their mobile devices, things like that. So I think part of that is just, these companies are growing as a portion of the economy. So that's fine. And, back in before 99, not, big companies, they listed on the New York Stock Exchange, not what was over the counter. That was, for the wild ones. So I think it's becoming legitimized to some extent. And that's where companies actually want to list if you're a big tech company. But I think that spike up over the last year or two is a little bit of concern that may, return back. So I think it's a little of both. There's some reason, there's hints there that we're seeing some overvaluation, but it's also just signs that the new economy is changing as far as the profile of businesses, companies in it.
Could you define valuation? Did you say that 2/3 of the federal government operations are being paid for with debt?
It's 1/3. So yeah, 1/3. So yeah, it's like 2 trillion. I'd say 2 trillion in debt's probably a safe number for 21 versus 5 trillion in expenditures. So yeah, that is an extremely high amount. But part of that is because we're in a recession and tax receipts are lower. I think what was almost more alarming is the $1 trillion deficit in 2019 when the economy was good. I mean, I guess I'm kind of old school where you try and, pay down the debt when that was, when things were good. I remember read Hamilton's Blessing. It's a very short book, but talks about Blessing is the federal deficit and the federal debt and how it's managed, and that you can pay for things like wars and then pay it down when things are good. So that's kind of been thrown out the window. So certainly something that there's a lot of uncertainty around it today. I mean, this modern monetary theory is still just a theory that I don't know if real economists think it's a good idea, but if you happen to work in Washington, they seem to think it works. So there's a lot of uncertainties there going forward.
Okay. This kind of gets back to the GameStop phenomenon. Are hedge funds an asset to the overall investment community or just a form of casino gambling?
I think hedge funds are there's a wide range of hedge funds. Let's say that there's some small hedge funds that you know, the big thing for hedge funds is the fee structure, which is very beneficial for the hedge fund manager. Some are actually doing some real investing in not just long only, but or not long and short, but doing a lot of buying, not just selling things short. So there's a handful. There are some good ones, and there's some bad actors in there. I'm not saying. I mean, short selling does I think have a place in the economy. It can be used for, for hedging, for protecting positions, not just speculating on. And it also, I think, keeps market participants more honest. It stops bubbles from getting out of hand, things like that. So I think it has a place, but I do think there's some bad hedge funds. There's probably a lot more bad ones than good ones. But I would say, they do have a place as far as doing in-depth research and, finding, some of them do find some good companies. So give them credit for that.
How does the student loan debt affect the federal economy?
It's an impact. I think it's still a fairly small percentage. It's a small percentage debt overall. It's a big percentage of younger people's debt now because college costs keep going up. So I think the bigger impact is, I think that the bigger question is, how do we manage education expense? And we're living in we'll get into globalization another day, but high school education is not adequate anymore. I mean, to live in this economy, we're shifting to more skilled workers, not manufacturing and things like that. That will, whatever you try to add tariffs, that's still going to be done overseas because that's where our strength is, and you can't change that. So, so obviously everyone needs better education, a bachelor's degree, the minimum, probably more hopefully some kind of graduate degree. So, we need to figure out a way to educate people, whether it's college education or vocational training, without breaking the bank. So, but I don't think it's a huge drag on the overall economy, what we have now. So, but it is, something that needs to be built. I think the system needs to be addressed.
Okay. Do you foresee China or another country putting pressure on the US markets? And if so, how do we balance our investments?
Yeah, and China is probably, an enemy going forward. I think the new administration is going to be a little more open to China, but I think it's going to continue to be a tension. So I think that's, they are going to be more of an adversary going forward, and trying to challenge us in technology and things like that, much of which has come from stolen intellectual property from the US and other countries. So I think that's another, another thing to watch going forward, is that with everything else that's going on, it's probably not going to take center stage, but yeah, I think, that trading, as far as a trading partner, they're going to be, it's going to be a not as good a situation.
Okay. There's some talk about eliminating the long-term incentive capital gains tax. Do you think this is likely, and how would it affect the economy?
I don't think it's likely. I think that that was on the initial platform. There are a few things like that, capital gains, the cost base, the cost basis step up at the time of death, and a couple other things that I think would be tremendously unpopular. And I don't think, as moderate as the Senate is, I think that's highly unlikely to pass. And I do think it would be negative for the economy. I think there's, I think it would dissuade people from, it could raise stock prices. It could dissuade people from investing in new businesses. I don't know about that, but it may dissuade people from, selling out of one business and to, these serial entrepreneurs to go start another one. So I think that would be a hindrance.
Okay. What does valuation mean?
Valuation is just kind of a metric of how we look at the price of stocks. So if you look at a stock and say it's $100, we don't know if it's expensive or cheap. It's relative to how much the company is doing in sales and cash flow and earnings. So we're looking at it relative to earnings. So, if the historical price to earnings multiple is usually 10, that means they're earning $10 a share. If that stock goes to 200, they're still earning $10 a share. That valuation then becomes expensive, and we have to wonder why it is. So that doesn't. Then you have to take into account things like future growth, and does it make sense for that valuation to be higher?
Thanks. There's one question that, and by the way, we're sort of wrapping up. I think we've gotten to most of the questions, but there's one that keeps coming up. And that is, when is the next barbecue?
I think see the vaccine chart for that one. But we would love to have everyone for a barbecue.
That's great. Well, thank you so much, Steve. Thank you, Jane. And thank you all for attending this year's Economic Outlook webinar. Both the recording and Steve's presentation slides will be available on our website by next week. If you have any questions, please let us know. And thanks again for your help and continued support. We truly appreciate it. We hope everybody has a great day. Take care. Bye-bye.
Thanks, everyone.